December 7, 2017, 8:45 AM EST coming to an officially regulated market near you this month. Bitcoin futures. Trading the cryptocurrency will start on December 10 on the Cboe Global Markets Inc. exchange, and by December 18 on the world's biggest futures exchange, CME Group Inc. This means neither restricted access nor the risk of dubious counterparties will stop hedgers, financial institutions or the downright adventurous from getting in on the mosttalked about new instrument. Yet the two bodies are struggling to persuade members to provide the clearing services crucial to gaining critical mass, unsurprisingly given the tulipstyle mania around Bitcoin and the ever more insane price swings. The chief lobby group for futures brokers, the Futures Industry Association, is pushing back at the speed and ease that the regulator, the Commodity Futures Trading Commission, has waved this through. It all seems pretty futile. In all likelihood, traders will find a way to access clearing services even if they have to avoid the main providers. While no big bank has enthusiastically endorsed Bitcoin futures, none has ruled out involvement. If they don't do the clearing, smaller non-bank brokers will. Many proprietary risk trading firms can self-clear anyway. More than sixfold in 6 months Bitcoin's surge. Source Bloomberg. With such global interest, there's an inevitability about Bitcoin futures. Are the banks really going to let their customers drift to the competition? If one caves in, the rest will surely follow. The leaders in futures clearing are Société Générale SA, member of a huge range of exchanges, and ABN AMRO Group NV, a futures specialist for prop traders. JP Morgan Chase Co., Citigroup Inc. and Bank of America Corp. will be crucial too to making Bitcoin futures acceptable, as will big non-bank clearers such as Interactive Brokers, TD Ameritrade Holding Corp., and ETRADE Financial Corp. Interactive's billionaire chairman is pretty alarming on the potential damage from Bitcoin futures. Wild ride. New highs for Bitcoin is pushing volatility higher again. Source Bloomberg. But fear of missing out, FOMO, to use social media parlance, is driving cryptoland. The CME and Cboe have their trading customers to satisfy and they're screaming for this. Build it and they will come. Smaller clearers will rush to fill any gap. And, in fairness, there's a game attempt to stop this being completely off the scale Wild West stuff. It's a cash-settled futures contract in US dollars, with no actual delivery of Bitcoin required. The exchange will impose a minimum initial margin, the deposit required to trade a specified amount of futures contracts of 35%. That's 7 times more than for trading oil or mini-SPY equity futures. There will be a twice-daily requirement to make sure the 35% buffer is intact, given Bitcoin's constant swings. Clearing members can impose a higher limit if they want. 12-minute trading breaks will kick in if the daily price moves 7% away from the previous day's settlement price, then again at 13%, and a hard limit at 20% when all trading will cease unless trading can restart within that band. There are no stated plans to offer options on the futures until the contract is fully established. That would be too much rocket fuel. Intraday breaks. CME Bitcoin futures would have been suspended twice on volatile trading like Thursday. Source Bloomberg. This is standard stuff that allows trading in a highly volatile instrument under most circumstances. And it's well within the 35% initial margin. Bitcoin did drop nearly 20% on November 29, but this would have triggered the hard price limit. The extra liquidity of additional players may even temper the sharp moves, as Bank of America points out hopefully. At present, Bitcoin traders have 2 options: long or flat. With futures, you can be short too. The big banks understandably fear the moral hazard of processing trades on such an absurdly volatile instrument, citing all manner of capital risks to the clearinghouse system. Not all these fears stack up, though. There's no obligation to deal with clients unless you want to. But there's the rub: futures traders will move to clearers that will. This column does not necessarily reflect the opinion of Bloomberg LP and its owners. To contact the author of this story, Marcus Ashworth, in London at mashworth4@bloomberg.net, or contact the editor responsible for this story, James Boxall at jboxall@bloomberg.net.